Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. So today we have another interesting webinar with Mr. Dhaval Kapadia from Morningstar. I'll give a quick context to this webinar. All of us understand and all of us are cheering equity markets at all-time high. Nobody could have imagined the way equity markets have actually shown a run-up over the last 1.5 years. Many investors have actually built a lot of wealth. I can vouch that because we deal with many HNI clients, and that is why you can see the kind of confidence that we see in the equity markets. And actually, for long-term investors, equity is always considered to be a best asset class. Anybody who invests with the horizon of 10 years, only one should be bothered about investing in good businesses, and wealth is automatically made. However, now when market levels are very high and valuations are soaring, it is definitely wise to understand various right approaches for one to invest fresh at these levels. Also, all investors are not alike, and all risk profiles are not alike, and hence we thought of doing a session with Morningstar, because Morningstar comes with more than 4 decades of experience, having advised and having done a lot of research into the space of equities, and they have launched a multi-asset portfolio which basically balances between various types of assets and tries to generate optimum returns or better superior risk adjusted returns. And track record has been actually quite compelling, and that is where we thought of understanding from Dhaval, who is the specialist and manages portfolio at Morningstar, to understand from him how are Morningstar fund managers actually managing equity investors money at these levels for such markets. What are the kind of drawdowns such portfolios have shown at various points of time? Because to investors, the behavior is also very important. And when markets fall and portfolios also fall, obviously that spoils the behavior, and many investors actually at that point of time are unable to manage. And a balanced approach to portfolio using multi assets actually controls that behavior and brings in that discipline, and ultimately investors end up winning the game. So all these aspects we will learn and understand from Dhaval. I will give a quick background and introduction to our speaker today. Dhaval Kapadia, who today we have as a speaker, comes with 25 years of experience, and he's a chartered financial analyst, also a CFP by qualification, and he's a veteran in investment advisory and portfolio construction business. We will understand from him in detail about Morningstar, about Morningstar's portfolio, and how Morningstar is actually optimizing the returns. Over to you, Dhaval. Welcome to you, and the entire platform is yours. We would like to understand from you in depth, and then once you have done your presentation and covered the initial half of this entire 1 year session, we will do a Q&A one-on-one. I have some questions noted down, and we will note down more questions from the audience, and then we will cover them all in the end. Over to you.
Sure. Thanks a lot, Kamal, for the kind introduction, and good evening to everyone who's joined us today. Hope all of you are doing well. Like Kamal said, obviously markets have been on a roll. The last 1 year, the rally has been pretty strong, and most people weren't expecting this kind of such a strong bounce back since the lows of the pandemic. Lows of the markets at the onset of the pandemic last year, right? And when we are talking to investors today, a lot of people are wondering, what they should do. Should they stay invested? Should they sell off, or should they buy more at these kind of levels, right? And the other question that comes up is that if people decide to reduce allocations or reduce their exposures to equities, where should they put their money, right? So that's should they invest in equity in other equity markets, or should they invest into debt or gold or any other sort of asset class, right? So today what we're going to talk about a little bit, and which Kamal touched upon earlier as well, is talk a little bit about both sides of single asset investing. So what that means essentially is the risk and reward trade-off when you're investing into individual asset classes such as, equity, debt, gold, and so on and so forth, and compare that approach to a multi-asset investing kind of an approach. So with that, if you give me a moment, I'll just share my screen, and Kamal, if you can please confirm if the screen is visible.
Yeah, your screen is visible. Absolutely.
Okay. So, so just sort of, getting on in terms of the presentation, just a quick sort of, introduction to Morningstar. Probably a lot of you, some of you might have heard of this about Morningstar as such, but just to give some more background, Morningstar is a US-based investment research and, investment management firm. It was started in 1984. Initially, by our founder Joe Mensueto to provide, research and information on mutual funds. In the US at that point of time, there wasn't enough information available on mutual funds. There was a lot of information on stocks that was available for end investors. So he started this company, in a small way, in a one-bedroom kind of an apartment to provide that, data and research on mutual funds. Gradually, we've built out. Currently we are present in about 29 countries with more than 8,000 employees within the group as such, and we've tried to build a trusted name in independent investment research, right? And our mission has always been to empower investor success. So what this means essentially is to create great financial products that help investors achieve their financial goals. So that has been the mission of the company from the word go, so to say, right? And talking a little bit about and quickly about the investment management group, which I am a part of globally. So this team is responsible for providing investment advisory and portfolio management solutions, to end investors, and in many geographies we do this by partnering along with platforms such as PMS, AIF World, or other advisors and wealth management firms as such. So that's how we deliver these solutions to the end investor, right? And the group is essentially split into 3 regions, so which is Americas, EMEA, and Asia Pacific. Now, within each of these 3 regions, there is a hub or a center of excellence that's identified, and all the countries within that region work closely with that investment team in that in that hub or like I said, center of excellence. So for Asia Pacific, for example, it is Sydney in Australia, where we have a large investment team, and all the countries including us work closely with the Sydney team to build portfolios and strategies for the local markets, right? The idea out here is combining local portfolio management expertise with our global resources, right? And in terms of global resources, we have about 95 investment professionals within the investment management group. And as most of you would appreciate, investment professionals, this would refer to people whose day-to-day job is to track markets, build views on asset classes, manage money, and so on and so forth. So there is a fairly sizable team that has been sort of built up to support this business as such, right? Just quickly moving on in terms of our investment principles, right? So I'm sure a lot of you have been interacting with a lot of investment managers, portfolio managers over a period of time, or asset managers, right? And everybody will talk of a different investment process that they follow to pick stocks, to do research, and so on and so forth, right? But we think the bedrock or the foundation, in other words, of any investment firm is the philosophy that they follow, right? I mean, in that sense, what is the philosophy? What is the broad set of principles that they follow, right? And which drive, their decision making, their thinking when they are managing money, when they're conducting research, they're picking securities, and so on and so forth. From our point of view, we've identified a set of 7 investment principles, and these are, principles that we've observed, famous or I would say long-standing investors, the likes of Peter Lynch, Warren Buffett, who've made, a name for themselves in the investment business over decades, right? So we've observed them following some of these principles, right? So the first principle is we put investors first, right? We believe that firms that put investors first win over the long term because the investor tends to win over the long term. So any product, any solution that we are creating, we're thinking of how it will benefit the end investor first. Next is we are independent minded. So what does this mean? So it means that we believe that if you have to generate performance that's superior or different from the markets, you have to think differently. If you buy when everyone else is buying and sell when everyone else is selling, your performance will be entirely, market linked in that sense. So therefore, we like to take independent views. At times, we may be contrarian to markets, and I'll talk of some of those views as we go ahead as well. But but as long as they are backed by our fundamental research, we are not afraid of being, contrarian to markets as such. Next is we are long-term investors. So typically, our views across asset classes are for 3, 5, 7, 10-year kind of periods, right? So by being a long-term investor, we are able to ride through the market cycles and identify opportunities at low points in the market cycle. Like, a classic example is March, April of last year when the markets corrected sharply. And if you're a long-term investor, then you should be thinking that, where are the opportunities? But if you're a short-term investor, you're thinking, how do I get my liquidity out of the system, right? Next is we are valuation-driven investors. So we believe that the price that you pay for the value of a security or an asset class is a key driver of the performance that you generate over the long term. In other words, valuations, we believe, are very important drivers of long-term performance. So therefore, valuations form, core or an important part of our investment process. Next is we take a fundamental approach. So what this means is that our analysts spend more time in doing fundamental research, understanding cash flow drivers for different asset classes and so on and so forth. And we don't focus too much on technical kind of analysis, which some other market participants might tend to follow. Next is we strive to minimize costs. So we believe that high costs impact investor returns and investor wealth over the long term. It impacts, it reduces the positive effect of compounding. If the costs are very high, it can reduce your wealth over the long term. So we strive to minimize costs in the investment solutions that we offer. And finally, we build portfolios holistically, right? So what this means is we believe portfolio construction is not just about adding more securities to a portfolio or adding more stocks or adding more funds or whatever it is. It's about adding asset classes, different asset classes that react differently to different economic scenarios, right? If everything was to go up at the same time and go down, then your portfolio is really not very diversified. So when we think of diversification, that's what we are thinking, that is the asset class that I'm adding, will it react differently, in a certain economic scenario as such. And just quickly talking about the areas that we've, as an investment management group, we've focused on and, tried to build on. So, 3 areas essentially. One is asset allocation. As investors, I'm sure, or rather I would hope that you're familiar with the importance of asset allocation. It tends to be the most important driver of performance. In other words, the decision on how much to invest in each asset class is the main driver of long-term portfolio performance. So that's an area that we've tried to build on, that how do you construct asset allocation models? How do you make them more forward-looking and so on and so forth? The next one is fund research or manager selection, which is, providing forward-looking views on mutual funds, on ETFs and other such instruments. So that's an area that we've tried to build our skill sets around, over the last several decades as such. And finally, combining asset allocation and fund research into portfolio construction, right? So these are the areas that we've tried to build upon. So, just moving on a bit, and we spoke about a little bit of this at the beginning. I hope this slide is visible. So, obviously, like we said, the markets have had a strong run up over the last 1 year. So what we're showing out here on this particular slide is one is equity market, so which is Indian equities, which is a red line out here. And along with that, you have US equities, which is S&P 500, which is the blue line that you see in between, and then you have the global index, which is called as the MSCI All Country World Index. So along with that, there are 2 other asset classes that we've included out here. So the green line indicates how gold has performed, during this period, and how debt has performed, which is the gray line in between, which is like a steady line. It hasn't moved significantly, which is what you would expect out of debt. So all of these asset classes have been rebased to 100 rupees. So what that means is if you had invested 100 rupees in any of these asset classes in Jan of 2020, how would this have moved over the last about 17, 18 months or so, right? So obviously, as we know, in March, April 2020, equity markets underwent a sharp correction. In India, equities were down by about 35, 37, 35 to 40% or so. Even global equity markets corrected, although the correction was a little bit lesser. US equities and global equities as a whole, the blue and the yellow lines also did see a correction, but not as much as Indian equities. Interestingly, at that point of time, an asset class such as gold was doing reasonably well. So, these asset classes corrected, and whereas, gold was on a sort of a positive kind of a trend. So it, in a way, moved up, which is again something that one would expect, gold to be, in times when there is a lot of market volatility, gold tends to do well, which is what we saw for a certain period last year, right? And debt remained relatively steady, but obviously we saw a quick bounce back in some of these equity markets, particularly globally. Markets recovered their losses, by about June, July July, August of last year or so, and this is probably after the first wave closed out, and then there were hopes that a vaccine would be coming soon. So that is what in a way boosted equity markets. Obviously, it was supported also by central bank activity, pumping in a lot of liquidity into the system. Indian equities took a little bit longer to recover the losses, but since then the rally has been strong, as we've seen. So Indian equities recovered their losses by about November or so, of October, November of last year, and then since then the rally has been pretty strong, right? So the question then pops to mind is for most investors today is what next? The rally has been strong. Do we see this continue? And what are global experts thinking right now? And these are just some general comments that we put down, but from a few sort of popular global investors or global experts that a lot of people look up to. The general view that has been coming through is that is one of a little bit of caution, right? And markets have seen a strong rally. So a lot of experts are indicating that one can be a little bit cautious at this point of time when it comes to equity markets as such. And a couple of reasons around that is, one is inflation has been moving up a fair bit. Over the last few months, we've seen commodity prices move up. Metal stocks do very well because of commodity prices moving up, right? So some of that has resulted in inflation, plus the liquidity that central banks have pumped in has resulted in some concerns around inflation being higher. And in fact, in recent times, even in the developed markets, it's been relatively high, 3, 4, 5% kind of levels, which is above what they have normally seen in the past. So that is one concern. And obviously the rally has been strong. There are some concerns around valuation as well that global experts in a way are sort of highlighting. And that's a similar view that we hold as well at our end from a Morningstar perspective. So what next? Generally we've seen that we've obviously looked at how markets have done, various asset classes have done over the last about 12 to 18 months or so. Now, if we were trying to look at a slightly longer term horizon, right? If you look at, we'll now try and look at how each asset class, each major asset class has performed over longer term periods, right? And also try and understand the risk and reward associated with each asset class, right? And when we talk of asset classes, this means, as the basic ones, right? Equity, debt, gold and international equity. So we'll try and talk about each of these asset classes quickly. And, the reason why we are talking about all of this is that, a lot of investors we've observed that tend to invest more in asset classes that they gain comfort with, right? So if they're comfortable with equity, if they're comfortable with debt, they will tend to, stick to that. And at times they may tend to, forget or ignore the risks involved in those asset classes. So therefore, it's important to look at, both sides of the coin. So before I get there, there's a quick poll I would like to sort of put through. And I would request all of you to sort of, on the webinar to, submit your answers. And the question is, and I'll just publish this poll and then I'll read out the question as well. So is the poll visible, Kamal, if you can confirm?
Yes, this is visible.
Yeah. So the question is that what are the real returns generated by equities over the last 20-25 years? Okay. So as of now, 100%. Okay, I think most people seem to be indicating. And when we talk of real returns, this means the inflation-adjusted return, because inflation tends to vary over a period of time, as we know it. So to make it more comparable, and obviously inflation eats away at your wealth, right? So therefore, one should, at least we believe, one should look at real returns. That's what we try to do. So I think there seems to be an sort of okay. We'll just give it another few seconds. So I think we've got a mix of responses. There are some people who are saying it's 4%, but I think a bulk of the people are saying it's about 6 to 7%. So I'll just stop the poll here, and I'll just show up the numbers in that sense. So that's right. So Indian equities over the last about 20-25 years have generated a real return of slightly more than 7%, in fact, right? And if you were to compare this to other asset classes such as gold and fixed income obviously here means debt. So gold has generated a real return of about close to 4%. So it has beaten inflation, which is what one would expect, but the return after inflation has been lesser than equities. And this is, we are taking a 25-year period. So, almost 25 years, I would say, 1996 to the current sort of period as such. And then, fixed income has also generated a real return, but that's been lower at about 2% or so, right? But this is one part of the story. The returns look very great, no doubt. I mean, over a longer term, a real return of 7%, I think is exceptional. But that's only one side of the coin, right? I mean, like they say, in Hindi, picture abhi baki hai. So we'll look at some other areas as well. So the other aspect of investing is obviously risk, right? I mean, one is returns or the reward that you get. The other is the risk, right? And when we think of risk, and I'm sure as investors, that's what probably you would be thinking of as well, is what is the downside, right? What could be, my drawdowns, or what could be the level of negative returns, that one could sort of, witness in a particular asset class. And we look at all asset classes. So first up, we put up Indian equities. Now, what we've done out here is, again, over, in fact, a slightly longer, about, 20 years or so, we're looking at drawdowns in Indian equities, right? So drawdowns means the maximum value of investment to the lowest point, right? So if I had invested, say, 100 rupee into the markets, into Indian equities in, say, January 2008, what was the maximum fall when we saw a correction in 2008? What was the maximum fall in my investment before it started to recover? So that is what the maximum drawdown refers to, right? So here we've identified periods where the drawdowns have been more than 20%. So from the peak to the trough, or the highest point to the lowest point, the fall in the markets in India, in Indian equities essentially, has been more than 20%. So there were 4 such periods over the last 20 years when the drawdowns exceeded 20%. And some of them, again, we might be familiar with. Early up, you had 2000, 2001, when the IT bubble bust, in that sense, the tech bubble bust, IT stocks had run up quite a lot just before, in 1998, 99, and then you saw a significant correction. So Indian equities at that time were down by about 58%, right? And then secondly, you had, the global financial crisis in 2008, 2009, when Indian equities, the maximum drawdown was about, close to 64%. So there were 2 periods when the drawdowns were around 60-odd%, and then there were, a couple of other periods when the drawdowns were about, 20%. And last year, as we discussed earlier, at the onset of the pandemic, when markets corrected by about 37% or so. The other thing to note along with these drawdowns is the recovery periods, right? So what does that mean is essentially the recovery period means that if you had invested, like I said, 100 rupee, at the peak, say in Jan 2008, right? And the market saw a correction of about 60-odd%, as we're seeing here. How much time did it take for you to recover your initial investment, which is at 100 rupee? So the capital that you invested, how much time did it take you to recover that capital, right? Now, after the global financial crisis, it took about 86 months, right? So about, practically about 7 years. So it was in 2013-14 when the markets really crossed the previous peak. So it took about 7 years for somebody who had invested in Jan 2008 to practically recover, 6 to 7 years to practically recover their initial investment that they had made, right? So in other words, at times the drawdowns can be steep, but the recovery periods also can be long. So somebody, if they had a goal of say 5-6 years, they wanted money, or they wanted to use that money elsewhere for meeting their other goals. After 5-6 years, and if they put that money into Indian equities in early 2008, it would have taken them 6 to 7 years to just recover that money. So it might have become a little difficult for them to achieve some of these goals, right? So that's another feature of equity investing. One is the upside can be great, which we saw at times, but one has to also be mindful of the downside of the losses as such, right? So if you were to compare this to other asset classes, right now, what we've done out here is, again, we've just picked those 4 periods that we saw in the previous slide, and we've compared Indian equity drawdowns to 3 other asset classes, which includes gold, fixed income, and international equities. So as you can see, the blue bar out here indicates Indian equities. The drawdowns which we saw in the previous slide are for Indian equities. And during that same period, what was the drawdown in the other asset classes? So the gray bar indicates international equities, the green fixed income, and the yellow is for gold, right? And as you can see, across each of these time periods, the other asset classes have fallen, lesser than Indian equities, right? So whether it's the global financial crisis or even last year, to a certain extent, you might expect it of fixed income. Debt is supposed to act as a cushion to the portfolio and as a safety net, so to say. So it fell lesser, during that period. And then, you had, gold also saw, some correction in some of these periods, but then it saw, a sharper recovery as well, right? And international equities, like we said, has fallen lesser. So that's important to keep in mind that, different asset classes will react differently can react differently at different points of time, right? And that is what is coming out here clearly in that sense. And why are we talking of drawdowns? In fact, before okay, maybe in the interest of time, I'll carry on. I thought I'll add a poll here. But why are we talking of drawdowns, right? I mean, why are we talking of the downside risk, right? One of the reasons clearly is that, the extent of drawdown that you see in your investment, if there is a fall in your investment, say you've invested 100 rupee and it falls to, there is a 20% correction, the 100 rupee goes down to 80 rupees, right? The percentage return that you will need to, recover your initial investment is more than the fall in the investment. So what it means essentially, if the 100 rupee were to fall to 80, right, there is a fall of 20%. You actually need a 25% return to go back to your 100 rupees, right, to the original investment. So the steeper the fall and the greater is the return that you need to go back to your original investment. So, for example, like we saw in the global financial crisis, Indian equities corrected by 60 odd %. So if your investment falls from 100 to 40 rupees, in other words, it falls by 60%, you actually need a return of 150% to go back to your 100 rupees, right? So therefore, in other words, and because the return that you need is quite significant, right? 150% return, it may not necessarily come over a short period of time. And that's why you see at times the recovery periods were long, because you needed, 150% return, which came over a period of time. And that is why it took you time to recover that, original investment that you had made. So the point we're trying to make is that it's not just the upside that one needs to be mindful of, but also the downside. Is there a way in which I can reduce my downside and generate more optimal returns or generate good returns from my investment? So that's equally important, as well as looking at the upside. Also trying to manage the downside is an essential feature of investing as well, is what we believe. So what's the way out, right? So one way is obviously, how do I generate optimal returns? How do I ensure that that the returns that I generate in terms of risk and return, how do I optimize the two, or how do I balance the two, right? So one approach could be multi-asset investing. Now, what does this mean essentially? Multi-asset investing essentially means is combining asset classes that are subject to different economic drivers. So in other words, can I build a portfolio of different asset classes which will react differently to different scenarios, right? And which is what we saw in some of the slides earlier when the markets corrected, how different asset classes moved, right? So therefore, each asset class will have its own characteristics or features, and because of which they may react differently to different scenarios. So Indian equities, we know out here, is you're getting exposure to Indian economic growth drivers. So when the Indian economy does well, Indian equities would tend to do well, and if not, then it wouldn't. If the Indian economy is not doing so well, like we saw, 2018, 19, Indian equities didn't do so well at that point of time, right? So that you have exposure to Indian economic growth drivers. Global equities gives you exposure to a larger opportunity set. In other words, obviously we know all of those names, whether it's the Facebooks, the Apples, but there are many more companies. I mean, those are the stocks that people are more familiar with these days. But there are, a large number of companies and a large number of, entities that you can invest in, globally, and that is what global equities provides, is a large opportunity set, and it also provides, foreign currency exposure, to so to say. And then, gold, again, it provides you a hedge against inflation and also against the currency as such. And debt, again, as we saw, is a, generally at least AAA, AA rated debt, the cash flow is more secure in that sense. So therefore, it provides a cushion to the portfolio. So these asset classes would tend to act differently in different, scenarios, in which is what we'll see as we go ahead. So Kamal, I think you've put up a poll. Do we want to wait for the responses, or?
Right. I thought, it would be interesting to know the answers.
Yeah.
It will help you to understand the thought process of the audience.
Sure. Fair enough. Yeah. I think it seems to be sort of divided between, okay, I think there's still responses coming in. But I would have waited till the end of the presentation to put up this poll, Kamal, so that, we are able to talk a little more. It's a valid question, but... So
you can announce the results, and we'll do this poll maybe again in the end.
Yeah. So I think it appears to be about, as of now, about 54% that are talking about, they're saying a multi-asset portfolio at the current level, about 30%, I mean, the percentages keep varying every minute, but about 30% equity and about 15% odd in a portfolio of equity and debt, or a hybrid portfolio of equity and debt. Should I end the poll, or would you do it? Yeah. So multi-asset investing, like I said, is combining different asset classes subject to different economic drivers as such. And we've spoken a little bit about international equities. Just quickly, a little bit more about it. I would say we've referred to international equities. We haven't spoken so much about it. So why look at international equities in the first place, right? And here, there are two charts that we put up, and which in a way talk about how one is how the global market is represented. I mean, when we talk of the global equity markets as such, so India forms about less than 2 to 3% of the global equity market index, right? I mean, US forming the largest component. If you were to look at indexes such as the MSCI All Country World Index, this is how the composition would largely look, right? So about slightly less than 60% to US, and then you've got many others that are also quite substantial. India is still a small component, although it's growing, and we know it will grow over a period of time. But then, in other words, there are many opportunities outside, and India is still, small component of the global market index. And similarly, even if you look at the global GDP, India is at about 3 odd percent. US comprises about 25%. China is 17. Japan is about 6%. So UK and then other European and other countries comprising about 45%. So in other words, whether you look at it from an economic perspective or from a global equity market perspective, India, although it's growing, but it's still a small component. So what that means is that there are many more opportunities outside, and therefore we think international equities makes a sense to include in your portfolio as such. And just quickly looking at another perspective in terms of why should you look at diversifying your portfolio, right? I mean, we're talking of multi-asset and so on. So what we've done out here is put down the calendar year-wise returns, right? So calendar year means 2008 till the current year to date. We put down the returns for various markets and asset classes, starting from US equity, developed markets, European equity, Indian equity, fixed income, and emerging markets equity. So, and all of these returns are converted into rupee terms. Again, I know this is a busy slide. I don't want you to necessarily look at the numbers. But what we've done is for each calendar year, the asset class or market that has performed the best is marked in a dark green shade, and the worst performing asset class is marked in a dark pink kind of shade. So that's what one can probably track as such. So as one can see that over a period of time, these greens and pinks keep changing quite a bit, right? So there is no constant asset class which has always been at the top, nor has been there an asset class which is constantly at the bottom, right? Although US equities have done fairly well, but still there are other markets that have also done well from time to time, right? The interesting thing to note out here is also that in periods when Indian equities haven't done well, say if I were to look at a period such as 2019, when Indian equities generated a return of about 9%, US developed markets or other equity markets generated better performance in that sense. So they were all up 20-25% plus, right? Similarly, you go back to 2013, Indian equities, along with that was when the first taper tantrum, which is now a concern with markets also right now, that Fed rolling back its sort of liquidity programs and stuff like that. So which is what also happened in 2013. So Indian equities and some other emerging markets underperformed, but developed markets did pretty well at that point of time. So in other words, the message out here is that it's very difficult to pick winners and losers on a year-on-year basis. So to an extent, it pays to be diversified. And also, as I mentioned, that in periods when Indian equities haven't done well, other markets have done well during some of those periods as well. The other thing that we've done out here is we've also added a multi-asset portfolio. So this is like a 50-50 portfolio, 50% equity, which includes 40% Indian equity, 10% international, that is a 50% equity, and out of the remaining 50%, 45% is debt and 5% is gold, right? So that portfolio has been marked out in the middle out here, which is at number 3 in that sense. So that has been at least relatively more steady as compared to most other asset classes. So it has neither necessarily been always at the top, but it's not been at the bottom as well. So, and if you look at the end, the last column, we've also put down the annualized return for each of the asset classes as well as the multi-asset portfolio, right? So that portfolio has done reasonably well as compared to, other asset classes. At least the period that we've picked, global equities have done better than international equities. So this is about 12-13 year kind of a period. So that's again another reason why it pays to be sort of diversified in that sense. So keeping all of this in mind, and in terms of the importance of asset allocation and the role that multi-asset strategies or portfolios can play in a client's portfolio, we've launched a bunch of multi-asset strategies. So these are 4 portfolios that we've been offering in India over the last couple of years or so. And as you can see, each of these portfolios is suited for different risk appetites and investment horizons, starting with a balance which is suited for a 5 to 7 year horizon with somebody with a moderate risk appetite. And as your risk appetite and investment horizon increases, the level of risk increases. And these are multi-asset portfolios. So essentially, we are investing into Indian equities, international equities, fixed income, and potentially gold. So these are the broad asset classes that are included in these portfolios, right? And secondly, each of these asset classes is further split into smaller buckets. So what that means is that Indian equity is split into large, mid, and small. Within international equity, we are looking at 3 geographies, which is US, Europe, and emerging markets. And again, fixed income is short, medium, and long term, and cash, based on duration. So there is a bunch of asset classes, and the idea is that because we believe that each of these asset classes can provide a different risk and reward, right? I mean, and they may react differently to different scenarios. Like if you take the example, if you go back to about 2018 or so, I mean, you had from 2014 to 17 in India, you had a very strong run up in equities. Like small and mid caps went up 2.5 to 3 times, correct? But after 2000, large caps did well, but not as much as small and mid caps. But between 2018 and maybe early 2020, small and mid caps saw a correction of about 50-60%. Large caps were steady. I mean, they didn't correct so much, they were generating some positive return. So in other words, some of these asset classes would react differently in different scenarios. So that's why we have these asset classes in the portfolio. And secondly, the allocations are actively managed based on our views. So in what that means is that if we think an asset class is looking expensive, like we said earlier, we believe valuations are an important part of the investment process. So therefore, when an asset class is looking expensive, we would reduce exposure to that and add an asset class which is probably looking slightly more attractive, from a risk and reward at that point of time, right? So if you look at, if I just want to quickly pick up one chart out here, say the growth portfolio, the allocations that you see mentioned on the chart is essentially about 54% Indian equity, about 16% international, and about 30% fixed income and cash. So these are like neutral or strategic allocations. So if you believe that markets are trading at fair valuations, or these asset classes are trading at fair valuations, this is how the portfolio would be, how the allocations would be sitting for each of these asset classes. But as we know, markets tend to be, on many occasions, either overvalued or undervalued, right? So therefore, based on our views, the allocations could vary within the ranges that are mentioned below each of the graphs. So for the growth portfolio itself, the domestic equity allocation would vary from 40 to 70. So if markets are looking expensive, we would be, below that 54%, which is mentioned on top there. And if markets are looking cheap, or relatively attractive, like was the case in March, April 2020, we might be slightly above that 54% level that's mentioned here. So similarly, the ranges for the other asset classes are mentioned out here. So just quickly moving on, and I know we need to keep some time for Q&A, so we'll try and close out soon. How will the allocations in the portfolios move, right, over a period of time? These are multi-asset. Like we said, the allocations are actively managed, right? And typically, the way these allocations would tend to move is when markets have disappointed, right, and valuations are looking reasonable. Like I mentioned, March, April of last year, that's when we will tend to reduce cash and debt in the portfolio and add equities, add more allocation to equities in that sense, right? And similarly, if markets have seen strong run up, have seen strong gains, and valuations are looking stretched, is when we will tend to reduce our allocations to equities and add more allocation to debt and cash in the portfolios as such. I'll skip a couple of these slides because maybe we can cover them later on during questions if required, but these were essentially talking about how the allocations are moved, but keeping given that we've almost 45 minutes, 35 to 40 minutes down. So just to sort of summarize on the proposition as such, so we believe that in terms of the proposition that we offer in terms of the multi-asset strategies, they offer an end-to-end kind of a solution. So in other words, right from asset allocation to fund selection to portfolio construction and review, the entire all of these areas are covered in the strategies that we offer. Secondly, you have options that are suitable for varying investment needs, like we saw, right from a balanced to an aggressive plus. There are different portfolios meeting different investment needs. The next is, we believe that this proposition gives investors the advantage or benefit of both global as well as local portfolio management expertise, right? Because like I mentioned earlier, we work closely with our global research team to build views on asset classes and so on. So therefore, you have, in a way, you're able to benefit from both global as well as local research and portfolio management expertise as such. And finally, lower costs. These portfolios invest into mutual funds or ETFs or index funds, as the case might be, and we invest through the direct share class. So therefore, the expenses, the underlying expenses are lower, and the management fees are relatively more competitive as such. And the overall focus is on trying to generate superior risk-adjusted returns. So it's not just returns, but also how do you manage the risk and generate superior risk-adjusted performance as such. And finally, providing also fundamental diversification by investing into international equities. So that's another aspect that comes through with these strategies as such. Just quickly to sort of wrap up in that sense, the key takeaways from what we discussed today, at least to our mind, is that one is single asset investing can generate wealth, but at the cost of higher risk or uncertainty, which is what we saw in the initial slides. Next is what we also saw is that international equities provide exposure to varying growth drivers and can act as an effective diversifier. We saw that international equities during drawdown periods in many cases have fallen lesser, right, and have also done well when Indian equities haven't done very well in certain periods. Multi-asset strategies help in generating better risk-adjusted returns. And finally, Morningstar has been helping investors across the world achieve their financial goals. And like I said earlier, our mission has been to sort of empower investor success. So with that, I'll stop here, and with one of my favorite quotes from Warren Buffett, which says a lot, right? So that investing is simple but not easy. So Kamal, over to you.
Right, Dhaval, thank you so much. I think this was very interesting and insightful presentation. The foremost question, that comes to my mind when I think of, a multi-asset portfolio, especially your multi-asset portfolio, is that let me first of all understand from you, what is, Morningstar's current market view at these valuations? And, we have seen obviously rally over last 1.5 years, but many investors, you and me included, were always looking forward to this rally for a very long period of time.
Correct.
2018, 19, 20 were not so good years for
Exactly.
equities, right? And now we have seen this rally. On one side of there are investors, there are fund managers who believe that this is a sustainable rally. Maybe we are back in the era of growth as we saw between 2003 and 2008, where world GDP will also grow, India's GDP will also grow, and obviously hence this is a era where corporate earnings will definitely there, and consistency of corporate earnings will ensure that valuations remain where they are, and they do not just touch the sky, and hence one is not chasing peak, one is seeing this to continue, and hence thinking about market levels is not right, but actually investing in good businesses is what will continue to build wealth. And obviously there is a recency bias also, and that is why investors today are definitely not wanting to sit outside of equity, whether it be through balanced funds or through multi-asset funds or pure equity funds. As you saw in that poll, investors want equity in some form or the other, right?
Yeah.
But because you are a research house, you have a view on various asset classes. I would want to understand from you, what is your view first of all on equity, and then maybe if you want to also cover views on gold, views on debt, and maybe offshore in the overseas markets, US, UK. Please spend maybe 2 minutes each, all of the asset classes providing the view.
Sure. Very quickly, I mean, just talking a little bit about Indian equity first up, I think, like you said, the last 12-18 months have seen a very strong rally. But if you look back 5 years, the returns now have come to normal levels. So if you look at the 5-year returns for Indian equities, they will be in the range of, say, 13, 15, 16%, thereabouts, a little bit higher for small caps, a little bit lower for, large caps and so on. So in other words, the rally has been strong, but because you had a couple of years in between when, markets didn't do well, like 2018, 19 and so on. So this is like a catch-up that's happened. So therefore, we think markets are probably slightly above fair valuation. So the way we are seeing it is that they are not very expensive. If you just look at the PE ratio, you'll think the markets are looking very expensive, because the PE ratio generally tends to look at the last 1 year trailing earnings. Most people look at last 1 year earnings when the earnings were subdued, right? Because last year you had the lockdowns and things like that, which has impacted earnings for a lot of companies, in FY 2021 as such. So, but when we look at a longer term, we think, Indian equities are looking a little bit maybe above fair valuation at this point of time. So that's the view that we have. We are in our portfolios, we are, neutral to slightly underweight Indian equities as such, right? And, so that's the view that we are holding on Indian equities. Talking a little bit about, international equities, that's a very diverse basket, right? But so I don't want to go down, country by country, but looking at main regions, again, US equities have seen, I would say, a much stronger run-up than Indian equities over the last 7-8 years. at least, the names that a lot of people are fancying, which is the big technology names, which are the most prominent names, the FANG stocks and so on, we think they've had a very strong run up. And probably in our view, that segment is one of the most expensive segments, globally as well. I mean, across major markets is the US big technology companies. So there could be segments of the US market which are not as expensive, but we think overall US equities are looking a little bit more expensive than most other markets globally. In terms of opportunities, where do we see, some of the opportunities or markets which are looking slightly more reasonably valued? One of them is UK, to a certain extent Japan as well. And an interesting opportunity which very recently our analysts have evaluated is China, right? We've seen, sharp correction in Chinese stocks. We know we read a lot about what's happening in China, the regulatory impact, but at least our view is that the correction, the impact has been on stock prices has been pretty strong. And, many of these stocks are down, 40, 50, 60, 70, or in some cases even 80%, right? So there might be some impact, or there would be some impact on their businesses, but we think, these companies are not going to go away, right? The Alibabas of the world are not going to go away. I mean, these have been built out by, in some way by the government themselves. So we think that looks like an interesting opportunity at this point of time, along with, a couple of other markets that I mentioned. Just quickly talking about fixed income and gold. So fixed income, at least we think the interest rate cycle in terms of seems to have bottomed out. So interest rates may not go down further from current levels. And, with inflation also picking up, there are chances that, in fact, over the next 12 to 18 months, you could see, some upward movement in interest rates globally, to a certain extent in India as well. So therefore, we think, but some of it seems to be priced in when you look at the longer end of the yield curve. So we think, the medium to long end of the yield curve still is looking reasonably attractive. That is the 4-year plus kind of segment of the yield curve, so to say. Whereas the shorter end probably is not looking as attractive at this point of time. Within the shorter end, still we think the credit risk segment is looking a little bit better. I know people moved away from that last year, but because of that move away, that segment is now starting to look attractive to a certain extent as compared to other segments on the shorter end of the curve. And finally, gold. I think gold is obviously a very difficult one to call, right? I mean, because there is no fundamental driver for gold, right? I mean, generally, because there are no underlying cash flows, right? Like you have in debt or in equities and so on, which is earnings, dividends, or coupon. But in gold, you don't have those underlying cash flows. So it's difficult to derive a fair value for gold. But again, gold has had a pretty strong run up. I mean, we see its role limited to maybe about 5-10% of a portfolio at the maximum.
Right. So let's try to understand practical aspect of your portfolio. What are the current allocations to all these asset classes currently that you're holding?
Okay. So if you if we have a few minutes, I could just pull up those slides which I hadn't run through, which have those allocations. Just give me a minute. So I'll just share my screen. Yeah. Is my screen visible?
Yes, it's visible.
Yeah. So essentially what we put up on this slide is how the Indian equity allocation has moved over the last couple of years. And I'll not go through the entire journey, but just talk of important points and where we stand currently, right? And this is Indian equity allocation in the aggressive portfolio, where obviously the allocation to equities is at the highest point, so to say. So the way we are depicting the allocation in this slide is into 3 buckets. Like I said earlier, the Indian equity is split into large, mid, and small cap. So then we are looking at allocations for each of these 3 buckets and how they've moved. So there are 2 things we've done here. One is we put down the strategic or neutral allocation. So if large, mid, and small cap were trading at fair valuation, how much would we invest in each of these buckets? So in case of large cap, it will be 48%. Which is the right-hand side y-axis. If you look at your right-hand side, the orange dotted line is at 48%. Small and mid caps, if they were trading at fair valuation, mid cap is indicated by the yellow dotted line, which is at 13% on the left hand side, and 7% small cap. So if each of these were trading at fair valuations, we would invest about 48% in large cap, 13% in mid cap, and 7% in small cap in the aggressive portfolio. Now, how have these allocations moved over a period of time? So when we launched the portfolios in April 2019, we found that Indian equities valuations were looking a bit stretched, so we were underweight. So the bold lines that you see out here, the orange bold is the actual allocation for Indian equities, or for large caps rather. The yellow bold line is the actual allocation in the portfolios to mid caps, and the green bold line is the actual allocation to small caps. So each of these are below their, the dotted lines, which we said are the normal allocations. So therefore, we were underweight. Now, come March, April of 2020, when we saw the sharp corrections, we felt valuations were looking attractive. A lot of people were confused because, the pandemic is something that most people have experienced for the first time in their lives, right? So a lot of people were trying to get a grip on the scenario, whereas we thought that, this might not have an impact on long-term growth. Therefore, we felt, markets were looking attractive, and we added about 12% to Indian equities in that period. So you see that jump in allocation across large caps in particular, and also to a certain extent in small and mid cap. And then over the last few months, after this strong rally, we've trimmed exposures, we've taken some profits off the table. Currently, we are at about slightly less than 48% to large cap. So in other words, close to neutral. The mid cap is around slightly less than 12%, which is slightly below neutral, and small cap is around neutral, and again about 7.5% or so. So like I said, we are slightly underweight Indian equities in the portfolios at this point of time.
Sure. So this, I think, answers most of the questions. There are a couple of questions which I see on the chat box. One of the question pertains to asking what is the portfolio allocation to various countries. So you have covered, but still, if you want to answer it further.
Sure. I can. In fact, I have a slide, so I can talk through this one. Like we said, in India, because one challenge that we face is that the number of investment options are a little bit limited when it comes to international, investing into international markets, right? The feeder funds and other funds are slightly limited although there is a reasonable number, but it's not as vast as what one would want. So therefore, we are investing in 3 regions, like I said, US, Europe, and emerging markets as such. So within that, like I mentioned earlier, we are sort of slightly underweight US equities. Now again, the green dotted line indicates the normal allocation to US equities in the aggressive portfolio, which is 12%. The orange dotted line indicates the normal allocation to European equities, which is 7%, and about 3%, which is the blue dotted line, which indicates the normal allocation to emerging markets. Now, as you can see out here and the blue bold line is the actual allocation to emerging markets. The sort of orangish, or I would say maroon bold line indicates the actual allocation to Europe, and the green bold line indicates the actual allocation in the portfolios to US equities. So as you can see out here is that we've been underweight US equities, in the portfolios as such, whereas we've been slightly overweight emerging markets and Europe in the portfolios as such. So that's how, even currently, that's how we are positioned, overweight to Europe and emerging, whereas we are slightly underweight to US equities in the portfolios as such.
Right. So is there a way to actually, give a proper number to, for example, 3 major asset classes, which is gold, equity, and debt? If the overall portfolio, investor is managing, you bring with you yourself 25 years of experience. I'm sure you would have gone through a lot of theoretical stuff as well as practically managing these portfolios, and being part of the core team at Morningstar. You could give theoretical understanding and perspective on these 3 asset classes, which is gold, equity, and debt. What is the allocation what one should manage? Is there any mechanism? Is there any parameter that one should follow to understand how to allocate between gold, equity, and debt?
I think the primary parameters that one should use to begin with is their risk-taking capacity and risk-taking willingness. right? So as an investor, what is your risk taking capacity? That capacity is generally determined by the investment horizon. So longer the investment horizon, the greater your risk taking capacity, because we've seen time and again across market cycles, particularly when it comes to equities, over short term periods it can be very volatile, but over long term periods it can be rewarding, right? So therefore, that if you're longer the investment horizon, greater your risk capacity, therefore you could invest more into asset classes such as equities. The second parameter that one should look at is the willingness to take risk, right? Is that what that is an inherent nature of people, right? I mean, each person is not the same, right? There are people based on their past experiences, etc., etc. They may, although they have a long-term horizon, but their willingness to take risk might be lower, right? So therefore, both of these should be taken into account. Ideally, if your risk-taking capacity or investment horizon is longer term, I would give more weightage to that as compared to risk-taking willingness. But both play an important role. So I think using both of these. So for instance, if somebody's got a horizon of say 5 to 7 years or something of that sort, or shorter horizon, say 3 to 5 years, then they could probably just look at a higher allocation, maybe just about 40-50% to equities, and the remaining could be in debt. And as your horizon increases, as your risk appetite, assuming that your risk appetite is also higher because you want to create more wealth, you want to build a corpus for achieving your various goals and so on and so forth. So you could allocate more to equities as your horizon sort of increases as such.
Even in the multi-asset portfolio, out of the four asset classes that we have discussed, equities is one of the asset classes which, as you showed in one of the graphs, has generated best real returns in long term. So even in the multi-asset portfolio, majority of returns would actually come from equities. Hence, it is important to understand from you what is the approach or philosophy that Morningstar follows in building equity portion of the portfolio. In terms of, are there any sectoral views that you have? What are the kind of number of stocks that you invest in? Any thoughts if you have?
Yeah, sure. So I think the first step that we try and take is to evaluate how each asset class, and maybe taking a step back. See, the purpose of investing is to meet future goals, right? You're creating wealth, you're trying to meet your future goals, right? So therefore, at least we believe one should look at asset classes, or how much to invest in each asset class. That decision, right, should be based on future expectations of these asset classes, right? That how are these asset classes expected to perform in the future. So that is the first step that we follow, is try and build risk and return forecast or expectations for each asset class. So for instance, for Indian equities, we will look at, because the market is broadly split based on capitalization, right? I mean, there isn't so much growth, value, and all of that. So large, mid, and small cap, what are our return expectations over the next 3, 5, 7, 10 years for each of these asset classes, right? Sitting today, based on fundamental factors such as earnings growth expectations and based on valuations. So what is the growth I'm expecting and what is the price I'm paying for that growth today? So both of these help us determine what is the return expectation over the medium to long term kind of period. Along with that, we also try to determine what is the risk. So today, where valuations are sitting, if there is a correction, if there are drawdowns, what could be those potential drawdowns? And therefore, what is the risk and reward? So that is the first step that we try and determine, that across the equity asset classes, whether it is Indian equities or international equities, we try and build out the risk and return expectations or estimates or forecasts for each of these asset classes, right? So that helps us determine which asset class is looking more attractive as compared to the other, right? So like I said, large, mid, and small, if I compare that to international equities, say US, emerging markets in Europe. So from a risk and return perspective, which asset class is looking more attractive today, and where should I put more money, and the one that is looking most attractive on a relative basis, I will put more money there as compared to the other buckets as such. So that's the sort of primary step we follow. Now once we do this, because like I said, we are the underlying investments are going into mutual funds, right? So therefore the next step is to pick the managers in the portfolios, that who, which are those funds or which are those managers we would want to be part of the portfolios, right? So there is a detailed qualitative and quantitative assessment that goes through. We talk to the managers, we understand their philosophy, we look at the track record, we look at their style, of constructing a portfolio, of managing the portfolio, and so on, and then we build, the underlying holdings in the portfolios. So that's like in a nutshell, how we go about it.
Sure. Right, Dhaval, it has been really pleasure interacting with you. And, the data that you have shared was very insightful. A lot has been learned. And I think, we can do a further round of discussion to address more queries. Multi-asset portfolios are rare. Especially investors in equity markets are wanting to invest more into equity focused portfolios because everybody is wanting to build wealth quickly. However, yes, a multi-asset portfolio, as you have displayed data, is quite meaningful. And in fact, in the overall context, any investor is managing all the asset classes on his own. By putting maybe some money to equity portfolios and some money to gold himself. Allocating some money specifically to a specialist like you through a multi-asset PMS makes a lot of sense. I understand, and I'm quite convinced, and that is where I really thank you and look forward to maybe another round of discussion, because this is a topic which requires investors to actually understand and deep dive. So this first interaction that we have done has actually raised a lot of thoughts, and we will have to do maybe more round of discussions. But
Sure.
thank you everyone for joining us, and thank you, and it has been really pleasure talking to you.
Yeah, same here. Thanks, Manoj, for hosting us. Thank you. And thanks to everyone who joined today. Goodbye.